someone that actually Forbes magazine has called him the alchemist of Dalal Street. Mr. Sharma heads the Global Investment Strategy Group at First Global. And for the past many years, ladies and gentlemen, First Global has made several seminal calls on the market. He's someone who has been widely quoted in the Wall Street journals, by CNBC, Financial Times, and has also been featured on NDTV Profit a number of times. We're absolutely delighted to have him here with us today. Please put your hands together for Mr. Shankar Sharma, Vice Chairman and Joint Managing Director at First Global.
Ladies and gentlemen. And thank you very much, Sangeeta, my very good friend, for inviting me here to address all of you very illustrious people who are taking the message of financial inclusion to far and wide corners of the country. And the lady who was here before, I didn't get her name, but it was a very, very inspiring talk because I come from a woman-owned company, because my wife owns pretty much all the business, right from day one, actually. So I can appreciate that, and your husband has become NRI and left you with the other women. I took my wife along with me. So to that extent, at least, I'm a little bit better off. But yes, I can understand and appreciate that women make far better investors and financiers than men can ever be. So with that, let's jump into the presentation that I have. So what's your number one problem? क्या problem है? पैसा नहीं बन रहा है ना, in short. हाँ, client को बोल रहे हैं long term करते चलो, लेकिन वो अभी before we came, we were discussing exactly that I mean, what is the definition of long term? And if you look at the data for India, and I always say this, like I'm 55, 56, we were lucky that we entered this business, this profession, back in the late 80s or the early 90s. And from then we, again pure luck, got 25, 30 years of, or at least 25 years of a really secular bull run in which all of us became reasonably wealthy, at least wealthier than where we started out from. But the interesting thing is, from year 2000, if you take as a recent starting point, 20 years back, the compounded returns from the Nifty are about 14%. Go back 10 years, that falls to around 10%. Go back 5 years, that falls to between 5 and 7%, depending on which is your starting point. That is the real problem here, that we are perennially talking about long-term, but long-term, also defined in the Indian context, has become a permanent term. It cannot be so. People want to make money in reasonable time so that they can spend. Otherwise, अगर 60 साल तक खाली long term ही करते रहेंगे तो उसका मजा कब करेंगे, right? But unfortunately, that's not in anybody's control. India will deliver what it has delivered. But as financial advisors, you need to think, if this is the state of events, if this is what continues, what will happen to your income? What will happen to the earnings and income of your clients? That's the important thing, and that's what the focus of my talk is. So the real problem is SCARS, which is a single country, single currency, single asset risk. That's what all of you are running. And that's what even I have run for at least 50% of my useful life. That we were all exposed to a single asset class in a single country and running the risk, obviously, of a single currency. So here's a short story about a client in Dubai, more like a friend. Came to us, I think about 2018. And he had obviously, done a bit of mutual fund investing and then PMS investing, because PMS is back in the 2017 era had a pretty good run because there was a whole huge bull market in small caps, and PMSs typically are more small cap than large caps. So he had a good run, and then he pretty much lost it all because most of the capital he put in came in at the higher end of the market. So he came to us in early 2018, and we said, all right, I mean, why are you sitting in Dubai and still looking at only India? And there is a whole world out there that you need to focus on. So he said, all right, so tell us what we can do or what I can do. So, we put him on our global program last year, 2018, by the time it got done was 2018 middle or something. And the result was that that portfolio was up 35% in calendar 2019, in dollar terms. Okay? I'll show you one piece of data which I was just showing my friends there. So, in 2019, okay, and in fact, I'll come to that. I've got the next slide there. How did this happen? So we bought certain sovereign bonds that gave us between 40 and 80% returns on sovereign bonds, okay? Certain countries did really well. I mean, for example, Russia was up 45 to 50%. NASDAQ, obviously, we all know, 35, 40%. Brazil was up nearly 30%. Italy, I mean, talking deadbeat countries like Italy that, have virtually no growth, 25%. France was up 24%. Germany was up 24%. China itself was up in dollar terms 21%. Belgium was up 19%, etc., etc., etc. Right at the bottom comes the Nifty 500, which was 5.2%. Okay, I'm again comparing dollar to dollar. This is not local currency. That is the reality. That is the unfortunate reality of what equity markets have given us. As I just said, Russia up nearly 50%, Brazil nearly 30%. Corporate bonds, by the way, forget the sovereign bonds. Corporate bonds gave us 35% plus. And here is what India has delivered on a long-term basis. I just told you 2019 data. On a long-term basis, it's pretty much nothing at all. I mean, in rupee terms itself, in 10 years, if your returns are 10% CAGR, while the rupee is actually depreciated, so in dollar terms, you're virtually zero. I mean, you're not even beating Japan, and Japan, we all know, has been a deadbeat country or stock market for like 30, 35 years. And again, this is my favorite chart, has been so for a long time. The Dolex 30, which is the Sensex in dollar terms, 2007 peak was 4226. Current level is 4,700. Okay, now that is 13 years. 13 years on virtually zero returns. I mean, the point is not about India. So I'm coming to the larger point that I'm trying to make here. The point is not about India. If you have a single country, single asset exposure, ultimately you will regret that. Because my sole learning in my years of investing is that the more open your mind is and the more open your investment menu is, you will find ways to navigate every single market. Because कहीं ना कहीं किसी asset में bull market होगा. And if you remain focused on a single country or a single asset, single currency, you're going to miss out on the rest of it. And ultimately, it's not also just about making money, it's also about de-risking. So something or the other will save you. Something or the other will always save you. So अगर bond नहीं चलेगा, equity में debt चलेगा, डेवलप चलेगा नहीं तो अगर इमर्जिंग नहीं चलेगा, फ्रंटियर चलेगा, कुछ ना कुछ तो कहीं ना कहीं चलेगा ही चलेगा. So that's the big learning I have had, that keep your door open to ideas, alternative approaches, and keep the menu of choice pretty wide. And so that's a problem most of you have. Most of us have in this country. So, as I mentioned, India has been a laggard. And I'll tell you the reason for that. The reason basically is that you still have a problem of very high cost of capital. So again, if 6-7% is your alternative benchmark by way of risk-free rate of return, by the way, last 5 years, GSECs have delivered 7%. So why are we talking about or getting excited about 7.5% equity returns? So because of the high cost of capital, equities have to do 15-18% to justify relative to the volatility. And unfortunately, the data simply does not support that Indian equities are capable or have delivered those kinds of returns in the past. As I told you, from 2020 till today, it's 14% CAGR. Okay? I mean, and the return spectrum is degrading every 5 years. So what is the key to stress-free wealth building? I come back to what I have found. This is my learning. I'm here to only share my learning. Like I said, and I'm fond of saying that there are different paths to heaven. Okay, many of us can just do real estate and not even look at equity markets and become fabulous billionaires. Many people have made billions just investing in equity. So there is no one right way. But this is my learning. This is my half an hour to tell you what my learning is. My learning is that if you diversify globally through proper asset allocation, that is the way to making sustained wealth. And this knowledge dawned upon us in the 97-98 crisis. ऐसा नहीं था कि हम लोग को बचपन से मालूम था कि ये करने से पैसा बनेगा. 97-98 crisis for us was a turning point in our thinking, because we saw countries like Malaysia, countries like Singapore, countries like Indonesia, Thailand. They became basket cases overnight. Currencies were down 50, 70, 80%. I think the Indonesian rupiah fell like 95%. And then we said कि यार किसी दिन इंडिया के साथ ऐसा हो गया, and all our wealth is lying in one country, in a single currency, and that too in equity markets. हमारा क्या होगा? And that's when our thinking changed. And thank God for that. We have never had a single moment of regret. Now, what happens if tomorrow India becomes a basket case? And ऐसा तो नहीं बोल सकते कि मलेशिया को हो सकता है, इंडोनेशिया को हो सकता है, सिंगापुर हो सकता है, इंडिया को नहीं हो सकता है. कुछ भी हो सकता है कहीं पर. That we all understand that. It's not as if India has earned a moral right to never have a crisis, right? We can have a crisis. We are a large country and we are not immune to global problems. And if we were to have a crisis, where does that leave all of you or your clients in terms of their futures? And the hope trade is that don't start thinking कि मेरे साथ नहीं हो सकता या मेरे portfolio के साथ नहीं हो सकता. सब कुछ सबके साथ हो सकता है. And that is, I find that talking about risk somehow is perceived negatively in this country. And I only know this, that if you prevent and you manage to navigate the 50% down years, you will end up ahead. If in 99, 2000, you manage to avoid the tech meltdown and you saved 50-70%, you are ahead. 2008, if you manage to avoid the big financial meltdown, you are ahead. So you have to look at risk, you have to scan the future. There is no alternative but to be doing that. So from 99, we started building our global capabilities. And it has been worth every single dollar that we spent building those capabilities. And like, seriously speaking, I mean, forget about last 20 years. I'll talk a bit about that. And we started with companies like Nokia back then. So I'm talking about nearly 18, 19 years back. Advanced Micro Devices. And, really, we have covered global stocks, like I said, for now nearly 22 years, pretty much across the world. I mean, Amazon and Apple, of course, I personally bought in the early 2000s. It was, I think, a very, very simple thing. And frankly, in Wall Street, being Wall Street, they never will get inflection points right. While, probably our Indian analytical brain is probably a lot better than the American analytical brain. At least I believe so. So we were able to see things which were pretty obvious. So it was no great intelligence, straightforward trades. Netflix, 2010, when we bought it, from there, I think it's up 25, 30 times. Domino's Pizza, 25x. Twitter, Shopify, for example, we bought it at about 2 billion market cap. Now I think it's about 35 billion market cap in the last 4 years. I mean, there have been just incredible number of winners, which, in the last 5-7 years, I don't see anything of that order on a broad basis that India has given me. Okay, we have had winners, but nothing compared to these. But the point of what I'm trying to say is not about smart stock picking. It's really about asset allocation. And that each one of you will have to eventually become asset allocators in your own domains. Just selling a single product at the expense of the other products because it is profitable for you is not going to work. The markets are going to change. The economics of our businesses are changing. Economics of your business, of the distribution business will change, that you all know. We have to become asset allocators. Because asset allocation means that one is tactically, strategically positioned in all assets. You're not being partial to one over the other merely because you make more income in one particular asset. And these are asset classes all over the world. So that at any point in time, you're not inordinately exposed to, like I mentioned in the first slide, SCARS, which is single country, single currency, single asset risk. And why are asset allocation, risk management important in wealth creation? Because every investment data, and you can search this on the net, every piece of data shows you that in fact, nearly 90% of your returns will come out of your asset allocation decision. Only 10% will come out of your, which is 80-90% will come from your top-down decisions in terms of where your assets should be invested at that point in time. And stock selection just contributes 10%, but that's the sexy part of the business, that I bought this stock that went up 25 times or 30 times what I was talking about 5 minutes back, what many people will talk about. But that, frankly speaking, nobody in this whole world can get multiple multi-baggers. It's not possible. Nobody can. You will get 1 or 2 or 3. That's enough to make a good living. But when you're managing money, your individual excellence will fail when you try to translate that in a money management setup. Because if you try to start picking or hoping to pick winner after winner after winner in every era of the market, it's not going to happen. Warren Buffett, last 20 years, has been a disaster as an investor. He has missed every single multi-bagger. He has become obsolete. Hey, at 100 billion, that's okay. I'm not cribbing his wealth. All I'm saying is, even a guy of his intelligence and his experience has been found wanting in the new era of investing, which has been there in the last 20 years. Merely because he was good in one era, but he could not remain relevant in the next. And all of us will ultimately become irrelevant at some point in time following a bottom-up strategy. And that's the point, that most fund managers are spending their time looking for stock winners, but you'll get 1 or 2, you will not get all of them. It's not possible. Statistically, practically, it's not possible to get all the 50, 80 baggers. And that too not in a single market. That's the important thing. And the other problem is, no asset manager or fund manager has a holistic view of all asset classes. Equity wala ke equity बेचता है, gold wala के बोलता gold ETF कर दो, fixed income wala आके बोलता fixed income करो. But they are all peddling their individual areas of expertise or income. What you need is a holistic advice, or rather your clients need is holistic advice कि ये pie chart को allocate कैसे करना है. But who is going to tell you that which way your money is supposed to go? Equity guy will say equities are great. And like I said, bond guy will say, fixed income 6%, that's terrific. And gold guy is going to say the rupee is going to fall, so buy gold. And that's why buying ETFs and feeder funds don't work either. I mean, you can see that the chart that I read out, so Russia did very well. NASDAQ was the next. But hey, next year things will change. Nobody can say that NASDAQ will be the top 2 markets in the world or not. It could be like in the bottom 5, or India could be at the top. So the point again, as I mentioned, is keep an open mind. And you cannot do that doing ETFs or doing feeder funds, because they are always centered around a single market. Almost all of them. And which is what is required is dynamic asset allocation, that you are moving, you're moving across. And by the way, there is somebody who's trying to do an ETF for this, exactly this product. It's still work in process, but eventually that is the product that people or your assets or your clients will want. And we've done a lot of work on that in our AI-driven risk and return optimization model, but time is too short to discuss that. But we are cognizant that ultimately our business will also need that skill. If you don't have that skill, we are all going to become obsolete. So this is a bit about, how we do it, like how we got the sovereign bonds and, how we got the stocks, because again, that's a long and lengthy discussion and this is not the forum for that. But, you can find, like I said, that if you start looking out of India, you will find the world is awash and teeming with opportunities, without any doubt. Because see, we are all Indian, but we don't have to necessarily just think like an Indian. We have to think like a large globalized open economy, wherein our capital is mobile, our capital is like water, it can flow to the areas of the best risk-adjusted return that your money can buy. So net result, this is the data that we have for our global funds. CAGR of one is 18.3%, the CAGR for the other one is about 15.3%. Sharp is between 3 and 4. We've had a tricky period in the middle. You can see that blue and the yellow lines, but that's okay. Imagine, the fact of the matter is that in rupee terms, by the way, there has not been a single down year, despite the fact that India has been down at least 2 years in the last 6 years in rupee terms. That's the advantage you get by diversifying your assets across the world. And of course, I'm not here to market anything, but you can drop us an email if you want any advice on this at info@firstglobal.in. And read this again, that if you have a single country exposure, go back and see what happened to countries which are far better than India. See what is happening to China, by the way. Out of the blue, this virus comes and you see what damage it is doing to, in my view, the only rival to the US in terms of size and scale. But imagine, out of the blue stuff can happen. So we need to be cognizant of that. Stuff happens. And how prepared are you or your clients' portfolios for stuff that can happen to India? Because like I said, India has no divine right to escape all the problems the world can potentially face. And finally, thank you very much, but Sangeeta had requested me to add a couple of lines on where I see the markets. And typically I don't get into all that because where I see the markets is not something that is fixed for the year. Nothing is fixed, right? So if the view changes in the middle, I can't come back here to this empty room and give a speech again, right? That my view is no longer what it was. But the reality is that India has become a easy or a difficult market, depending on which way you want to look at it, that you have a very narrow list of stocks which are now, last year and a half have been performing. And that narrow list of stocks doesn't seem as if those stocks are going to slow down, simply because of the large-scale decimation of the economy in terms of companies, MSMEs or corporate India. Market shares are moving towards those companies. Now, why is it important for all of you to understand this phenomenon? And this is what I tell all my fund manager friends on the FII side who have been friends for 25 years, because now they face an existential crisis that ETFs are taking over their lives. It's reality. And you know why? Not because global markets have been on a secular bull run. It is because if narrower and narrower list of companies takes the markets up, you as a portfolio manager cannot buy just 8 companies in a fund of 1,000, 2,000, 5,000 crores. So what do? You have to buy 25 stocks. Moment you buy 25 stocks, you cannot beat the market. But what can beat the market or match the market? An ETF can. So the narrowness of the world has become polarized. Less and less stocks are contributing more and more to the gains of the stock market worldwide, not just in India, is making ETFs become a serious, in fact, it's a real threat. It's a threat to all of you in this room. It's a threat to us. But the only area where it's not yet a threat is in asset allocation. So again, go back and think, the way you can beat the ETF threat is by becoming an asset allocator rather than just becoming a product seller. And that is going to be the winners in this room, which hopefully next year we'll meet and we'll see who all understood this. Thank you very much.
Thank you, sir. Sir, could you please continue joining us? We would like to felicitate you, a small token of appreciation from FIFA to you. Could I please request Mr. Nikhil Nayak to come and join us on stage? Should I take that?
Yeah, sure.
Thank you, Mr. Shankar Sharma.